Have you ever stopped to think about how money is actually made? And I'm not talking about printing presses. It's this really fascinating process that happens every single day, right inside our commercial banks. Today, we're going to demystify how a simple, everyday loan can literally create new money in our economy. So, where does it really come from? If you're picturing these giant vaults stacked with cash or some government printing press just humming along 24/7, well, that's really only a tiny piece of the puzzle. The real story is so much more dynamic. And believe it or not, it happens every single time someone takes out a loan. Let's dig in and see how. All right, so here's our game plan. First, we'll cover what banks actually do. Then, we're going to decode their balance sheets. After that, we'll get into the secret of how money is created, show you the formula to calculate it all, the money multiplier, and then wrap up with some real-world limits on this whole process. Okay, first up, we gotta kind of rethink what a bank even is. It's not just a big safe box for your cash. Banks are what we call financial intermediaries. And honestly, their most important job is connecting people who have money saved up with people who need to borrow it. Just think about it for a second. Banks take all those deposits from savers, right? And then they turn around and channel that money to borrowers, people who want to buy a house or start a business or, pay for college. This super simple act of connecting savers and borrowers, that is the key. It's the essential first step that makes this whole money creation thing possible. It's what makes the entire system tick. So to really see how this all works, we need to peek behind the curtain and look at a bank's books. And the main tool we're going to use is the balance sheet. You'll often see it as a simple T account. It's basically a perfect snapshot of a bank's finances. And trust me, understanding this is the key to everything else we're about to cover. All right, so on one side of this T account, you've got assets. An asset is just something of value that the bank owns. Pretty simple. This includes the cold, hard cash it's got in the vault. We call that reserves. But, and this is super important, it also includes the loans the bank has made. Now, you might be asking, why is a loan an asset? Well, it's because that loan is a promise that someone is going to pay the bank back in the future. Okay, now for the other side of the T, liabilities. A liability is just anything the bank owes to someone else. And here's where it gets a little weird, a little counterintuitive. Your deposit, the money you put in the bank, to the bank, that's a liability. Why? Because they owe that money back to you. You can ask for it anytime you want. And this all leads us to the golden rule of accounting. Assets have to equal liabilities, always. This little T account is our window into what the bank is doing, and that equation has to stay perfectly balanced. So, ready to see it in action? Let's do it. All right, here we go, the main event. We're going to follow a single $1,000 deposit on its journey into the banking system. By tracking this one transaction, we are going to pull back the curtain on the so-called magic of how our money supply can actually grow to be way, way bigger than the initial cash that started it all. Okay, so picture this. You walk into the bank and deposit $1,000. What happens? Instantly, on the bank's T account, its assets go up by $1,000 in cash reserves. At the exact same time, its liabilities also go up by $1,000 because that's your deposit. They owe it back to you. See? Perfectly balanced. But here's the thing. Banks don't just let your cash sit there collecting dust. There are rules, called the reserve requirement, that say they only have to keep a small fraction of it on hand. Let's just say for our example, it's 10%. So the bank hangs on to $100 in its reserves, and then it can loan out the other $900. Now look closely at the T account. The reserves asset drops to $100, and a brand new asset called loans pops up for $900. Add them up, the total assets are still $1,000. And the sheet? Perfectly balanced. And this is where the magic really kicks in. The person who borrowed that $900, they're going to spend it, right? Maybe on a home renovation. And the contractor who gets that money, what do? They deposit that $900 into their bank. The money didn't vanish. It just jumped right back into the banking system. Pay attention, because this is the exact moment that new money is created. That $900 loan just became a brand new $900 deposit at a totally different bank. Your original $1,000 is still sitting on the books at the first bank, but now an extra $900 exists. The money supply just grew. And guess what? This whole cycle is about to start all over again. Now, look, we could sit here all day and follow this chain reaction, loan by loan, deposit by deposit, but honestly, that would take forever. Thankfully, economists came up with a simple little formula to figure out the maximum possible impact of all this, and it's called the money multiplier. And here it is in all its glory. The money multiplier is simply 1 divided by the reserve requirement. That's it. This powerful little formula tells us exactly how much the money supply can potentially grow for every single dollar of new reserves that hits the banking system. The math here is super straightforward. Let's use our example. We take that 10% reserve requirement. First, we turn it into a decimal, so that's 0.10. Then all you do is calculate 1 divided by 0.10. And what you get 10. So in this scenario, the money multiplier is 10. And what that number means is that for every single dollar of those initial reserves, the banking system, as a whole, can generate up to a maximum of $10 in total money. So what does that mean for our original $1,000 deposit? Well, we just multiply it by our money multiplier of 10. And the result? That one single $1,000 deposit can ultimately support a total of up to $10,000 in the money supply. That, right there, is the incredible power of what we call fractional reserve banking. Okay, but hold on. Before we get too carried away, we gotta bring this back down to earth for a second. The money multiplier gives us the maximum theoretical amount. In the real world, the actual effect is almost always smaller. And that's because, the system isn't perfectly efficient. You see, this whole process is limited by what we call leaks from the system. For example, what if banks decide to hold on to more reserves than they're required to? Well, then less money gets loaned out. What if people decide to just hold on to physical cash instead of depositing it? That money can't be multiplied. And maybe most important of all, if businesses and people just aren't looking to borrow money, the whole creation process just grinds to a halt. And that leaves us with one last really important question to chew on. We've just seen how lending creates money. So what happens to the money supply during something like a recession, when banks get nervous and lending just slows to a trickle? Think about it. The incredible process we just walked through, it can also work in reverse. Something to think about. Thanks for joining me.